The number you see on your screen right now, 145.56 USD, is an optical illusion of the highest order. If you are just tuning in and glancing at the ticker for SMX, Security Matters PLC, you might assume you are looking at a well-established mid-cap technology firm, perhaps a steady software provider, or a specialized manufacturer trading in the same zip code as some of the more robust names in the industrial sector. That assumption, while understandable, is dangerous. The reality of SMX is not one of stability, but of aggressive, high-stakes financial engineering designed to keep a heartbeat going in a public listing that has faced immense pressure. The price you see is not the result of a decade of compounding growth like you might find with Apple stock. It is the mathematical result of a relentless series of reverse stock splits that have mechanically propped up the share price while the actual market capitalization remains in a precarious micro-cap state. When we strip away the surface-level data, the movement we are seeing today, a slight decline of nearly 0.5%, is merely the surface chop on a much deeper, more turbulent ocean. To understand why SMX is trading at this level, we have to ignore the high share price and look at the structure of the stock itself. In just the last few months of late 2025, this company has executed multiple reverse splits, consolidating shares at massive ratios, recently an 8-for-1 split in November, following a 1-for-10.9 split in October. If you held shares of this company earlier in the year, your position has been condensed and condensed again. The expectation from a casual observer might be that a stock trading over $100 has escaped the volatility of the penny stock world. The reality is that SMX has brought the volatility of the penny stock world up to the $145 level. The tension here is palpable. The company is fighting to maintain NASDAQ compliance, specifically the minimum bid price requirement, and they are doing it by shrinking the float to a tiny fraction of what it once was. This makes the stock incredibly sensitive to low volume. A single large order on Interactive Brokers or a wave of retail sentiment on SoFi Invest can send this thing careening 20% in either direction within an hour. Let's talk about who is actually trading this. You have a mix of algorithmic traders who prey on the thin liquidity created by these splits, and you have deep value speculators who are betting that the underlying technology, which we will discuss, is finally about to catch a bid from a major industrial partner. If you are sitting at home managing your own capital through Schwab Intelligent Portfolios or looking for investment help on forums, you have likely seen this ticker flash on top gainer or top loser lists repeatedly. That is the nature of the beast right now. It is a stock that lives in the extremes. The intraday action today shows a struggle to find a floor. The bid-ask spreads are likely wider than what you would see on Nvidia stock, meaning if you try to enter a market order, you might get filled at a price that puts you immediately in the red. This is a trader's environment, not an investor's rocking chair. The volume today suggests caution. The market is waiting to see if the recent $111.5 million equity purchase agreement amendment will dilute shareholders further or provide the runway the company claims it needs. So, what is the actual business behind this chaotic chart? This is where the story gets fascinating and where the value argument tries to make it stand. SMX is not just a shell. They possess a proprietary technology that physically marks materials, solid, liquid, or gas, with a molecular reader. Think of it as a DNA barcode for inanimate objects. In a world obsessed with supply chain transparency, ESG compliance, and circular economies, the ability to prove that a specific ton of recycled plastic or a specific bar of gold is authentic is incredibly valuable. They call this the identity layer. The expectation is that major global players in mining, fashion, and manufacturing will adopt this technology to prove their green credentials. If Tesla stock relies on a clean battery supply chain, SMX argues that their tech is the only way to prove the cobalt or lithium is ethically sourced. They have rolled out initiatives like True Gold for tracking precious metals and have partnerships for tracking recycled plastics. But the gap between having a working technology and having a profitable public company is where shareholders have been burned. The reality is that commercial adoption has been slower than the cash burn. Developing molecular physics-based technology is expensive. Maintaining a global sales force is expensive. Staying listed on the NASDAQ is expensive. To fund this, SMX has had to rely on financing deals that often involve issuing new equity, which dilutes the value of existing shares. This creates a cycle. The company needs money, so they sell stock or sign equity lines. The stock price drops due to dilution, they do a reverse split to get the price back up, and the cycle repeats. If you are using Fidelity Investments or their Fidelity mobile app, you might see the corporate action notices stacking up in your inbox. It can be exhausting for a long-term holder. The smart friend advice here is to recognize that until revenue from these molecular markers significantly offsets the operating costs, the stock is effectively a derivative of its own financing structure. This brings us to the broader market context. We are currently seeing a sector rotation where speculative tech is being punished unless it shows immediate cash flow. Unlike Robinhood stock trading enthusiasts who might chase a meme rally, institutional capital is being very picky. SMX falls into a difficult show me category. They have the tech, they have the pilot programs, but the market is demanding scaled revenue. The recent news of them amending their equity purchase agreement to potentially $116.5 million is a double-edged sword. On one hand, it gives them access to capital, which is critical for survival. On the other hand, seasoned traders on interactive brokers trading platforms know that these agreements often create selling pressure. The fund providing the capital usually converts their notes into shares and sells them into the market to lock in a profit, which can cap any rallies. I want you to pause for a second and think about the psychology of holding a stock like this. You buy in because you believe in the circle of economy and the idea of tracing plastic waste. You see a press release about a new pilot program in Europe. You feel validated. Then you check your Robinhood app 2 weeks later, and the stock is down 40% because of a financing announcement. The tension between your belief in the mission and the performance of the asset is the defining experience of the SMX shareholder. It's a brutal lesson in the difference between a good product and a good stock. They are not always the same thing. Comment below how many shares of SMX you currently hold, or if you are caught in one of the recent reverse splits. I want to hear how your cost basis changed after the consolidation. Let's look forward. What is the bull case that justifies a $145 price tag or whatever the post-split equivalent settles at? It relies on a tipping point event. If SMX announces a mandatory adoption by a regulatory body, for example, if the EU mandates that all imported recycled plastic must be molecularly verified and SMX is named the standard, then the math changes instantly. The revenue would theoretically go from sporadic pilot fees to recurring high-margin licensing. This is the lottery ticket aspect of the trade. It's why people still watch this ticker on Fidelity wealth management screens despite the pain. The potential for the technology to become an industry standard is non-zero. In the gold sector, the ability to prevent conflict minerals from entering the supply chain is worth billions in brand equity to jewelry and electronics manufacturers. If SMX captures even a fraction of that verification market, the current market cap would look absurdly low. But we must return to the risks because they are immediate. The company is in a race against time. The NASDAQ listing is their lifeline to capital. If they were to lose that and drop to the OTC markets, the pink sheets, their ability to raise funds from institutional investors would severely diminish. This is why the reverse splits happen. They are defensive maneuvers to keep the game going. If you are engaging in self-investing or using investing sites, you need to check the outstanding shares count regularly. With SMX, that number changes frequently. A low float can mean explosive upside on good news, but it also means the stock is susceptible to manipulation and extreme volatility. Comparing this to other volatility plays, you might look at the crypto markets available on Robinhood Crypto. SMX trades with similar erratic energy, but unlike a decentralized token, there is a board of directors and a physical headquarters in Ireland and operations in Israel and USA, trying to steer the ship. The geopolitical aspect is also worth noting. With operations connected to Israel, the company is not immune to the broader instability in the region, which can impact operational continuity. It's another layer of risk to factor into your Interactive Brokers account. The technical analysis on a chart that has been